Max Capital here, presenting this video about how to trade the US dollar efficiently. Now, the company presenting this content is Wall Street Institute and Company. Please go check us out on Instagram. It's wallstreetinstitute.co. On Facebook, it's Trade for a Living. Now, let's get to it. So, in years of my experience with trading and training people, I've realized that when you're looking at other students' trading history, you'd find that looking at their trades, how the trades are lined up, they'll be contradicting themselves somehow. What do I mean by this? You'd find somebody buying the US dollar, Japanese yen, buying the pound, the pound, US dollar. Now, technically speaking, there's a conflict there, there's a contradiction there. So you really need to understand correlation, how basically the interrelationship between currency pairs, so that you can diversify. Because if you're buying the US dollar, Japanese yen, and buying the pound yen, basically you're contradicting yourself and you haven't diversified your portfolio. So now let's dig deep into the technicals so that we can understand how we can trade in United States dollar efficiently. Now, I'm bringing about this video because this week, today is a Wednesday, so in 2 days time, there's NFP, which comes out at every first Friday of every month, basically reporting on the employment data from the United States, which will indicate the direction of the economy probably in the month of May. So now, in front of us is the United States dollar index, which indicates the strength and the weakness of the United States dollar. Now, order flow wise, you can tell that we've been on a bearish move, like lower highs, lower lows, lower highs, lower lows, etc., etc. So but we need to focus on these market structure or what's happening near current market price so that we can get the most relevant piece of price action. Now, I'm going to remove everything and probably bring my chart to the center so that everything is clear, expanded a bit as well. So top of thus, we find this type of structure, which is a corrective form. Remember, this is from the higher time frame structure. Now, what this is telling us is in a formation of a flag, if you may, but from a higher time frame. So what this is telling us is that at some point, the dollar index has to drop and go for the lows of 11,400, if you may. But then if we go into a lower time frame, because high time frame structure is good, but then you also need to know or get to understand what is happening now, because what's happening now is what's going to give you the truest picture of price action and the directions we can anticipate. So I'm looking at this, connecting the most recent highs. This is what I'm looking at on the dollar index. Now, I'm sure by now you've realized that we use chart patterns, but we're primarily supply and demand traders. We just use chart patterns to add that extra confluence, and sometimes you get these sweet entries or sniper entries, if you may. So now looking at this, so we have this corrective structure, which means price still has to come down. Now looking to the left-hand side, so one would try to find a supply and demand zone, but then what I'm seeing here is this previous area of support, which has a high probability of turning into resistance here, called SR-FIB, if you've done a course in QML, Quasimodo. So supply and demand wise, there's a very nice supply area here. You see, the reason we combine supply and demand with chart patterns is that it helps us tell us which supply or demand area has a high probability of holding. As you know, supply and demand is got done with drop, rally, base. You've got the rally, base rally, etc., etc. Sometimes it can confuse you or very tricky to understand which one will work. Now, drilling to the last lower time frame that we go to according to our strategy at Wall Street Institute and Company, which is the 1 hour, just to still see clearly what's happening, always irrelevant to the current market price. So we could easily go check price for what was happening in 1999, but then it's going to take us ages before that piece of information becomes relevant. So from this, I'm sure you can already tell that we'd expect a movement to the upside before we can commit to the downside, probably to these lows. I don't know where we would go after this. So with the NFP coming Friday, now this can happen this Friday. It can happen today, it can happen the following week, it can happen the following month. Now, nobody knows how price action plays out in the financial markets or when it's going to play out in a certain way. All we can do is analyze, use our strategies to make sure that we have the edge or the odds skewed in our favor, so to speak. Now, with that said, short term, we're expecting the dollar index to push to the upside. If I go to a high time frame, so that we can see this price action here. Zoom in a little bit here. So we're expecting price action to go up there, firm negative touch there, and coinciding with the SR3 or even that area of supply before it can go to the downside. Now, with that said, short term, remember, mark my words, hear me right, short term, we're expecting the US dollar index to go up. So what does it mean to a pair that has the United States dollar as a base currency, like the United States dollar, okay, the Japanese yen? What does that also mean to a pair that has the United States dollar as a core currency, just like the pound, yes, the pound and versus the dollar? So if, say, for an example, we have the US dollar showing signs of being bullish. So what would we expect now coming to a US dollar Japanese yen? Because of correlation, now these are positively correlated, which means if the United States dollar index is pushing up, so the United States dollar against the Japanese yen is supposed to follow the same direction and become bullish as well. So how about now a pair like the pound US dollar that has the dollar as a core currency now? So we'd expect it to be bearish, right? Go to the opposite direction. Now, why is this important? It's very important because by so doing, you understand what we call diversifying. Because imagine a trader that has taken a buy on USD/JPY and a buy on GBP/USD. So basically, you're also contradicting yourself, right? Now, this info is vice versa. Say now the scenario that we're presented with is the United States dollar index showing us bearish sign instead of bullish sign. So this piece of information is very key if you want to know how to trade the United States dollar effectively. Now, with that said, let us look at the US dollar and the pound, US dollar yen and the pound dollar, just to see or ascertain if our analysis or our understanding of interrelationships between currencies, if it's in line with basically the theory that we've come up with. Right, so on top of high time frame structure, then order flow wise, the markets are bullish, but then it seems like we have a more corrective piece of price action here in shape of a flag. So now high time frame structure, right? Once again, high time frame structure is going to give us the truest picture of direction in the long term, but we need to drill down to a lower time frame to just connect the pieces of information because you know the higher time frame direction might not commit immediately or at the time we're looking at it to commit, because it has to still play according to the lower time frame structure. So we have that. So we might expect the dollar against the Japanese yen to go down. But once again, going now to the last time frame that we trading to, remember, which is our, excuse me, which is our 1 hour time frame. Now looking at that, if you look at this most recent piece of price action, now this does look like a pennant. Now a pennant has a higher probability of breaking to the downside. However, looking at this high rate, looks like we already reacted to this area of supply. We've already reacted to this area of supply. Wait, this one, right? So that was the first reaction. Then we had the impulse going down in that corrective phase. So right now, one can also say if we connect the most relevant piece of price action, there's also a high chance that the market will push towards those highs. Now, it's easy for price action to fall, or it's easy for institutional traders to fool retail traders in such a way that retail traders get caught on the wrong side of the market. So this is what I'm still seeing right here, because why? If I may remove that for now, it might basically give us the wrong price of action. There's that area of supply over there that hasn't been tested in a while. I think it will be much clearer on a 4-hour time frame. So now this is the piece of price action I'm talking about. So I would expect the US dollar to come here before it drops down. Now remember, the US dollar index is also showing some bullish signs. Short term once again, but in the long term, we would expect the market to tank or move to the downside. With that said, let us move to the Japanese, the pound against the United States dollar. I really love the Japanese yen. So looking at that, once again, high time frame structure. We cannot emphasize that enough. The importance of always looking at the bigger picture. You know, you hear seasoned investors saying, focus on the bigger picture, focus on the long term, what's going to happen long term. So connecting with extreme highs with extreme lows, once again, simply in a consolidation format. But order flow wise, this is a bullish market. Right. Trading to a lower time frame again, one can notice some pretty nice price action, but then we must be relevant. Relevance is very key. Speak to what's happening in the current market price. This is the case. I'm seeing this corrective structure. So this impulse and this corrective structure. But then before we can commit to the upside, now we have this thing that we call third drive pattern. So third drive, theory-wise, we still need to make this low before we can push up. Now, this will present us with the next probable movement, short-term movement of the pound dollar. So we're able to decide on price action. So we connect this, this corrective structure once again. So for me, it looks like it's going to skip this area and probably come back to react to this main area of supply that hasn't been reacted or respected and push to the downside. So just like that, ladies and gentlemen. Long term though, we are looking at a bullish market here. So short term, we're expecting this to come down to these lows of 1.37500, if you may, or 1.38, right, before it can push to the upside. So there you have it. Just to recap, the United States dollar index is showing us more bullish strength, meaning there's a higher probability of it pushing to the upside. Revisiting our analysis here, so we expect it to push up. So with United States dollar against the Japanese yen, we expect it to follow the same direction, based on correlation, right? We did look at correlation. Remember that piece of information as it right on top of the structure. So we expect the United States dollar against the Japanese yen to also push to the upside. Don't let this piece of information fool you, because this might just become, you see, a bigger corrective structure. So this might become a flag to revisit those highs of 110 and above. Now, with that said, the pound dollar is structured in the opposite manner, meaning now the United States dollar is a cold currency, so it's expected theoretically to give you sentiments towards the opposite direction like that. So we expect it to go down like that. So now that's it from today from us. Hope you have happy NFP and you make some profits when you trade on Friday. Be careful. However, here at Wall Street Institute and Company, we're not going to be trading dollar pairs on Friday because there's going to be lots of volatility, liquidity in the market. Now, liquidity could be a good thing, volatility not always. So we're going to wait for the following week when the market has deciphered the information and decided on a direction that's clear, that's going to move steadily instead of this erratic market movements that might result in us risking our money in setups that are not worth it. So now that's it from today. So please like, comment, tell us what more you'd like to see from us. If you did have any takeaway from these videos, and let's connect via our socials. Now on Instagram, it's Wall Street Institute .co. On Facebook, that is the handle there is Trade for a Living Movement. If you want to be in touch with me, I'm also going to share down in the description below my WhatsApp contacts. We can communicate, share value. We're all about value exchange here at Wall Street Institute and Company. Now, till the next one, keep safe, trade for a living. Cheers. Bye-bye.